There's a harsh truth about investing that very few people dare to admit. That truth is, your biggest enemy in the market isn't a sudden crash, it's not inflation, and it's not the big players on Wall Street. It's your own brain. We live in an age of information overload. Every morning you're bombarded with headlines. This stock is about to explode. Recession incoming. Warren Buffett just sold X, bought Y. Your phone won't stop buzzing with price alerts. Green and red charts dance across your screen, like the anxious heartbeat of the entire world. And in the middle of all that chaos, we're told we need to be smarter, faster, and find the next big thing. The result? Burnout, constant anxiety, sleepless nights, wondering if we just made a terrible decision. We're no longer investors. We've become gamblers stuck in a cycle of stress. But what if I told you that the most successful and peaceful investors in the world do the exact opposite? They don't try to predict the future. They don't spend hours glued to every tiny market move. And they definitely don't let headlines dictate their emotions. Instead, they build a fortress, a system, a set of unshakable rules, designed to protect them from their greatest enemy, their own instincts. In this video, we're not just going to learn an investment strategy. We're going to learn how to build that fortress, a surprisingly simple system called the magic formula that can free you from emotional stress and help you consistently outperform the market. Why rules beat instinct in investing? To understand why having a system is so crucial, we first need to confront an uncomfortable truth about human nature. Our brain is a masterpiece of evolution, honed over millions of years. It helped our ancestors survive predators, find food, and form tribes. It's hardwired to react instantly to threats and chase short-term rewards. A strange sound in the bushes? Run now. A ripe red berry? Eat it immediately. But that same brilliant brain is completely unfit for the abstract, logical, and delayed reward environment of modern financial markets. The instincts that once kept us alive now turn into deadly psychological traps. Take fear, for example. What once helped our ancestors escape a saber-toothed tiger has now morphed into loss aversion, the fear of losing money. Psychological studies show that the pain of losing $100 is twice as powerful as the joy of gaining it. This fear drives us to panic sell at market bottoms, turning temporary losses into permanent ones. On the flip side, greed, the instinct that once helped us hoard resources for survival, has evolved into FOMO, the fear of missing out. We see a stock skyrocket, hear everyone buzzing about it, and our primal brain screams, "Everyone's at the party except you. Get in now." And so, we end up buying at the peak, right before the party's over. Overconfidence, once useful for a hunter trusting his instincts, now convinces us we can beat the market with our gut feelings. We ignore hard data, bet on compelling stories, and soon learn the market doesn't care how we feel. Behavioral science has shown again and again, in an environment of high pressure, constant volatility, and deep uncertainty, emotions aren't your guide, they're your saboteur. Most people don't lose money because they're stupid, they lose money because they're human. So, where's the way out? If we can't trust our instincts, what can we trust? The key is shifting roles, from an emotional player reacting to every wave in the market to a calm architect building with a proven blueprint. That blueprint is a rule-based investment system. A good system creates a buffer between your emotions and your decisions. It acts as a logical filter, cutting through noise, panic, and short-term hype. It doesn't promise to win every battle, but it gives you a clear strategy to win the war. And over the long term, the data is undeniable. Systematic strategies consistently outperform the impulsive decisions of the crowd. One of the most widely discussed investment strategies originated from a small book with a modest title, The Little Book That Beats the Market. Its author, Joel Greenblatt, isn't just a legendary hedge fund manager with an extraordinary track record, he's also a professor at Columbia Business School. Greenblatt didn't write the book for Wall Street pros. He wrote it for his own children. He wanted to distill the complexity of investing into something so simple even a kid could understand and use it. And from that idea, the magic formula was born. What is the magic formula? Don't let the name fool you. This isn't magic, it's pure logic, wrapped in a simple two-step formula. It doesn't try to predict where stock prices will go tomorrow or next week. Instead, it focuses on answering two crucial questions. First question, is this a great business? Second question, am I buying it at a great price? To answer the first question, is this a great business? The formula uses a metric called return on capital. Think of it like this. Imagine two chefs. You give each of them the exact same basket of ingredients worth $100. The first chef creates a dish that customers are willing to pay $120 for. He earns a $20 profit. The second chef uses the same ingredients but creates a culinary masterpiece that people are happy to pay $150 for. He earns a $50 profit. Who's the better chef? Clearly, it's the second one. Return on capital is the metric that helps you find these master chefs in the business world. It tells you how efficiently a company uses its resources, money, factories, machines to generate profit. A company with a high return on capital is a money-making machine. It excels at turning each dollar of investment into many more dollars of profit. That's the first half of the equation. Find high-quality businesses. Now let's move to the second question. Am I getting it at a good price? To answer that, the formula uses a metric called earnings yield. This is basically the inverse of the P/E ratio you often hear about, but here's the simplest way to think about it. It tells you how much profit you're getting each year for every dollar you spend to buy the stock. Imagine you're buying a rental property. Apartment A costs $1 million and earns you $50,000 a year in rent. That's a 5% yield. Apartment B, with similar quality, costs only $800,000 and also brings in $50,000 a year. That's a 6.25% yield. Clearly, Apartment B is the better deal. Earnings yield works the same way. It helps you find stocks that are on sale, companies that are generating strong profits but whose shares are priced low relative to those profits. The higher the yield, the better the bargain. And this is where the magic of logic kicks in. The magic formula combines these two factors. It scans the entire market, ranks all companies based on how good they are, return on capital, and how cheap they are, earnings yield. Then it simply adds the two ranks together. The companies with the lowest combined scores are the hidden gems, high-quality businesses being sold at bargain prices. The process is incredibly simple. 1. Choose a list of companies to filter. 2. Apply the formula to find the top 20 to 30 ranked companies. 3. Buy them and hold them for 1 year. 4. Sell and repeat the process. No need to analyze charts. No need to read hundreds of pages of financial statements. No need to guess what the Fed will do next. Just follow the system. Buy, hold, rebalance, repeat. Why it works and what to expect. The philosophy behind it is elegant. You're buying excellent companies at moments when the market temporarily doesn't prefer them. Maybe they had a weak quarter. Maybe the entire industry is out of favor. But this system forces you to act rationally, to buy when others are fearful, and to trust in long-term quality over short-term noise. But does it really work? This isn't just theory. A 2022 study of the Norwegian stock market examined the performance of the magic formula from 2003 to 2022. The results were astonishing. Over that entire period, including the 2008 financial crisis and the pandemic's market turbulence, the strategy achieved a compound annual growth rate of 21.56%. This figure significantly outperformed the broader market benchmark. However, before you rush to apply this formula, there's an important truth you need to accept. This is the ultimate test of your discipline. No investment system wins every day, every month, or even every year. The magic formula is no exception. There will be periods, sometimes lasting a year or two, when it underperforms the market. This is what's known as the great filter. It's the moment when most people lose patience. They start doubting the system. They tell themselves, it's going to be different this time. So they abandon the strategy, jump back into the emotional roller coaster of the market, and sell their stocks, often right before the system begins to work again. Periods of underperformance aren't a flaw in the system. They're part of the system. They're the price you pay for long-term outperformance. It's the difficulty of sticking with it through those dark valleys that creates the reward for those who stay committed to the process. If you're looking for a silver bullet, a way to get rich quick, then magic formula isn't for you. Truthfully, nothing like that exists in the real world. But if you're looking for a path, a process, a way to build wealth methodically, steadily, and peacefully, then this is one blueprint that's worth exploring and deciding for yourself whether it's the right fit for you. Real success in investing doesn't come from making a few lucky guesses. It comes from having a solid philosophy and the discipline to stick with it through the storms of time. The magic formula isn't flashy. It won't give you thrilling stories to share at dinner parties, but it gives you something far more valuable: clarity, consistency, and most importantly, control. Not control over the market, that's impossible, but control over yourself. It frees you from the pressure of being a prophet and allows you to become an architect of your own financial future. If you're tired of gambling, tired of being yanked around by fear and greed, maybe it's time to change your approach. Have a system, stick to it, and give it time to do its work. If this video helped you see investing in a clearer, more grounded way, please hit the like button, share it with someone who needs to hear this, and subscribe for more smart investing content. Thanks for watching.